New Jersey's market just ended 2025 with more homes, lower prices, and longer waits. The next act hinges on a March deadline and a power grid already stretched thin. Here is what happened, why it happened, who is feeling it, and what it sets in motion for 2026. December closed quietly, but the numbers were loud. Across the Garden State, active listings stood at 14,335 in December 2025, up 11.16% from 1 year earlier and down 14.28% from November. New listings clocked in at 4,176 for the month. The median listing price was $529,325, a 2.42% drop from December 2024 and 3.58% below November. Sellers cut prices 25 times, 29.58% more than 1 year back, even as reductions fell 46.50% from November's cadence. And the median home sat for 56 days, longer than a month and a half from list to contract. Nationally, the backdrop was similar. Active listings fell below 1 million in December, the first time since April of that year. Yet that still marked the 26th consecutive month of inventory growth. The national median list price landed at $399,950, edging down 0.6% year over year. On timing, listings typically spent about 70 to 3 days on market nationally in December, 4 days longer than the prior December, marking the 21st straight month of year-over-year elongation. Price reductions touched 12.9% of national listings. Mortgage costs were steady. 30-year fixed rates ranged from 6.15% to 6.22% in December, and 15-year loans ranged from 5.44% to 5.54%. Steady rates, swelling inventory, and longer marketing windows set the tone. Zoom into North Jersey, and the texture sharpens. New listing flows told two stories at once. Compared with December 2024, Bergen posted 372 new listings, up 35.77%. Hudson logged 238, up 22.68%. Sussex saw 106, up 1.92%. But Passaic registered 132 new listings, down 10.81%. Morris posted 192, down 9.43%. Essex had 180, down 1.10%. Against November 2025, every one of these 6 counties slowed. Bergen's new listings fell 43.64% month over month. Passaic by 45.9%. Morris by 39.24%. Essex by 50%. Sussex by 43.62%. And Hudson by 30%. Seasonal gravity did its work, but the year-over-year lift in places like Bergen and Hudson hints at more sellers testing the water. Timing shifted too. Between list and sale, homes sat longer in December than November across all 6 North Jersey counties. Bergen's days on market hit 50, up 30.26% from November and up 2.06% from the prior December. Passaic reached 50-1 days, up 32.89% month over month, and up 12.22% year over year. Essex rose to 52 days, up 30.38% from November and up 0.98% across the year. Sussex notched 63 days, up 23.53% month over month, and up 9.09% from last December. Hudson posted 57 days, up 26.1% month over month, and up 5.58% year over year. Only one county broke the pattern year over year, Morris. There, the median listing spent 50 days on market, up 30.26% versus November, but actually 1.98% faster than the prior December. Slower than last month, slightly quicker than last year, Morris threaded the needle. Pricing told a more nuanced story. In December, 3 North Jersey counties were up year over year, and 3 were down. Passaic's median listing hit $549,900, up 5.5% from the prior December. Essex's median reached $578,725, up 5.32%. Sussex edged to $416,975, up 0.23%. Meanwhile, Bergen's median landed at $762,750, down 4.32%. Morris posted 600 and 509, $500, down 1.42%. Hudson's median reached $599,450, down 1.33%. Against November, 5 of 6 North Jersey counties slipped. Bergen fell 1.58% month-over-month. Morris, 1.32%. Essex, 1.07%. Sussex, 0.72%. Hudson, 0.09%. Passaic alone firmed, up 0.92% month-over-month. A market exhaling, with pockets still catching a bid. And price reductions, those little admissions that ask prices were a touch too high at first, rose year over year across most of North Jersey in December. Bergen recorded 96 reductions, up 29.73%. Passaic doubled to 44, up 100%. Morris saw 58 reductions, up 11.54%. Sussex had 42 reductions, up 10.53%. Hudson notched 92, up 21.05%. Essex was the outlier, 42 reductions, down 22.2% from the previous December. Versus November, cuts fell across the board. Bergen down 52%, Passaic down 45%, Morris down 35.958%, Essex down 52.27%, Sussex down 54.35%, Hudson down 45.73%, Hudson down 45.73%. Sellers tried less aggressive pricing as the month closed. Seasonal, yes, but the year-over-year climb in reductions across 5 of 6 counties shows negotiation is alive. Why did it play this way? Part of the answer is simple seasonality. December typically cools. New listings in New Jersey fell 29.5% month-over-month nationally, and the state mirrored that turn. But the longer arc reaches back across the year. 2025 was a year of false starts. Early rate cuts did less than usual because other fundamentals were unsettled. As the year matured, stability began to return. Tariff debates cooled, lenders re-entered, and buyers and sellers recalibrated to a rate world where 30-year mortgages lived between 6.15 and 6.22% for December, and 15-year loans between 5.44 and 5.54%. Stability changes behavior. As capital tiptoed back, demand shifted toward quality, location, and flexibility. In some corridors, Jersey City's waterfronts and nearby Gold Coast neighborhoods, lease velocity and rates remained strong, tugging renters and builders into transit-rich, walkable zones. The benchmark for Class A redefined itself. It became less about a facade you drive past and more about a lifestyle you can walk through. Class A meant a place where you can walk to, not drive to. Amenities intertwined with streets and storefronts. Convenience measured in minutes on foot instead of miles by car. Then there is the law. In 2025, New Jersey rewired the way it handles affordable housing. A landmark framework, known as A4, set municipal fair share obligations for a 10-year compliance period. Plans were drafted, reviewed, and, crucially, they generated obligations to rezone for many thousands of new homes, mostly multifamily and mixed use. The amended Fair Housing Act sets a hard date. Zoning for those projects must be in place by March 15th. That single date will ripple from planning boards to building sites, from lenders to residents. It signals new supply ahead, not everywhere at once, and not instantly, but enough to matter. Supply matters more when demand is stubborn. Across the Northeast, spaces continued to absorb during 2025, and by the third quarter, net absorption turned positive for the first time in more than a year. At the same time, new product deliveries remain limited. You cannot make more land in Bergen or Hudson, and single-family home sites are scarce across the state. Less ground to build on pushes the arc toward denser forms, multifamily, mixed use, last-mile distribution, and toward adaptive reuse when offices need new lives. The shipyard of the economy keeps moving. In Elizabeth, 2 giants, Mar Terminals and a Maersk affiliate, APM Terminals, signed lease extensions that stretch beyond 30 years. That is a bet on corridors, ports, and the logistics that make the state's tax base hum. If you think those decades-long deals happen in a shaky market, think again. They happen when participants believe the fundamentals, location, trade routes, labor pools, will still reward them 3 decades from now. But even when the big bets are bold, the daily math is disciplined. It looks like a buyer in Long Beach Island last summer sizing up a $999,000 listing after losing twice to all-cash bidders. Another offer came in. The easy play was to match the ask. The disciplined play was to think in value, not emotion, and come in at $950,000. That offer won. One number, $950,000, overrode fear of missing out and saved $49,000 on day one. In a market where 5 of 6 North Jersey counties saw more price cuts year over year in December, disciplined bids are not outliers. They are strategy. Sellers are reading the room too. In December, statewide price reductions rose 20 to 9.58% year over year, even as they fell sharply from November's level. That arc is seasonal, but it also signals a larger pivot. The past few years' fever is now a steady pulse. Statewide median list price in December sat at $529,325, while Bergen, the state's price heavyweight, posted $762,750. Passaic's $549,900 is nearly a $200,000 spread below Bergen. Morris's $689,500 sits between. Sussex remains the region's relative value at $416,970 and $55. Hudson's $599,450 underscores the range of urban core condos and townhomes that don't look like Bergen's Colonials or Sussex's Capes. Prices tell stories. Each county writes its own. Now the ripple effects. For lenders, the signal is green-ish. Conventional lenders are back in the market. Equity investors stand ready for the right project. In the third quarter, industrial markets logged positive net absorption again, and new deliveries remain thin. More capital on the lending side than deals to finance has created competitive benches. If the 10-year Treasury yield holds near 4%, large equity is poised to keep moving back into the market. That is the liquidity layer into which March's zoning actions will pour. Developers see that same horizon. Some anticipate 2026 as a year of increased transaction volume, both ground-up deals and leasing, after 2025's uneven start. With fewer new construction starts over the last cycle and approvals hard-won, vacant product is now getting more attention and stability is bidding to lower concessions later in the year. Early on, rents may be flat, with concessions still on the table. Later, if vacancy rates decrease across New Jersey, builders could kick off new starts that arrive in 2027 and 2028. But costs still matter. Materials inflation was a headwind in 2025. Pricing is stabilizing, rates are trending lower, and investors are returning. Yet one expense is climbing in ways owners cannot ignore: insurance. Rising premiums, propelled by more frequent storms, are pushing owners to invest in the exterior bones, drainage systems, parking lots, pavement, to reduce flooding, minimize surface failures, and harden sites. Those projects are not glamorous, but they are cheaper than repeated claims. The cost of ignoring resilience grows with every thunderhead. All the while, the demand map is shifting. Multifamily and mixed use will keep leading in 26. Affordable housing mandates will shape designs and approvals. Municipalities and developers are cutting deals that produce as-of-right units. Healthcare facilities and ambulatory centers look viable, with fewer entitlement hurdles and strong community support. Data centers march forward, driven by AI and the hunger for compute, but they are hitting a hard limit: power distribution. Reliable electrical capacity is becoming a premium resource. That bottleneck can stall projects that pencil on paper but cannot plug into the grid. In New Jersey's layered energy, environmental, and land use landscape, a clear roadmap and early risk management will separate what gets built from what remains a rendering. Across the state, location keeps winning. Projects that are steps from transit, Hoboken's rails, Newark's path, Jersey City's ferries, command attention. Netflix Studios is building into Fort Monmouth. Lionsgate is anchoring in Newark. 1,888 Studios in Bayonne is pushing Hollywood East deeper into the waterfront. For offices, Class A now implies walkable districts and amenity ecosystems. For industrial, last-mile distribution remains a staple as New Jersey's Northeast Corridor powers e-commerce. For retail, neighborhood centers anchored by daily needs, food, fitness, services, are holding their own, especially where they mirror local demand. So who is affected right now? Buyers first. In December, Bergen's 50 days on market gave room to underwrite inspections and contingencies. Passaic's 50-day one-days hinted at negotiating windows. Essex, at 50 days, and Hudson, at 57 days, offered similar timeframes. Across 5 of 6 North Jersey counties, price cuts were higher than a year ago. Bergen up 29.73%, Passaic up 100%, Morris up 11.54%, Sussex up 10.53%, Hudson up 21.05%, creating more entry points for disciplined offers. Statewide, the median list price at $529,325 is lower than a year ago. For first-time buyers, especially in Sussex at $4,169,975, that matters. Sellers feel it too. If your property is listed in Bergen, knowing the county's median at $762,750, and the December pace at 50 days helps set expectations. In Morris, the slight 1.98% year-over-year improvement in days on market to 50 days is an edge. In Passaic, where prices rose 5.5% to $549,900, but days on market also rose 12.22%, pricing strategy is delicate. December's fall in price reductions from November: Bergen down 52%, Essex down 52.27%, Sussex down 54.35%, does not mean fewer negotiations. It means sellers front-loaded adjustments earlier in the quarter and then let December ride out the season. Developers and municipalities are the next dominoes. March 15th is not a suggestion. For a 10-year compliance period, zoning for affordable housing obligations under a 4 must be in place by that date. Planning boards will be busy approving site plans, shepherding permits, and reconciling community feedback. Many thousands of new homes are on the drawing board across multifamily and mixed-use segments. Some single-family parcels exist, but the scarcity of vacant developable land makes them rare. Each approval will echo into construction pipelines that, by some expectations, could deliver new product in 2027 and 2028. The decisions taken before March 15 will define which towns grow, how fast, and for whom. Investors, the capital behind it all, are recalibrating too. In northern New Jersey's multifamily market, transaction volume is expected to surpass 21-5's tally in 2026. Cap rates are stabilizing. Garden-style value-add assets remain popular. The policy environment is tilting a bit friendlier for some buyers. The permanent reinstatement of 100% bonus depreciation under the One Big Beautiful Bill enhances returns for certain structures. Meanwhile, significant dry powder accumulated during the rate hiking cycle is poised for deployment, particularly if the 10-year Treasury yield stabilizes near 4%. Even as this capital lines up, the microeconomics of design are changing. Flexible floor plans, multi-use spaces, and work-from-home amenities, co-working lounges, reliable internet wiring, quiet rooms are becoming standard. Wellness features such as fitness studios and meditation rooms are no longer luxuries in competitive buildings. On-site EV charging and bike storage are not just nice to have. In transit-rich areas, they complete the mobility ecosystem. Smart systems, app-based access, IoT appliances, automated climate controls, lower operating costs, and elevate tenant experience. These features do not just rent units, they reduce churn and protect long-term asset performance. The industrial and technology sectors are not standing still either. Data center feasibility studies are up, but the limiting reagent is power. Designing a server farm is one exercise. Connecting it to reliable electrical capacity is another. In a state where energy and environmental regulations are complex and layered, projects live or die on how early and how well teams manage that risk. That is the difference between a groundbreaking and a press release. Even parking lots have a role. Owners are spending on maintenance-driven improvements, drainage, paving, structural repairs, phasing bigger plans into smaller, manageable projects. Measured spending is not a pause, it is a hedge against rising insurance premiums and weather events. An extra trench drain here, a resurfaced lot there, and a reinforced curb line can mean the difference between a nuisance claim and a catastrophic one when storms roll in. Exterior improvements are not optional if insurers price risk up. Through all of this, demand for the basics, housing near jobs, retail that fits daily life, industrial that moves goods, remains durable. New Jersey's dense population, strong employment base, and proximity to metropolitan anchors have long supported the market through cycles. Today's environment is less about speculation and more about fundamentals, cash flows, tenant quality, and locations with proven demand. It favors thoughtful planning and assets aligned with how people actually live, work, and shop. Let's connect the dots back to December. Inventory is rising, pricing is recalibrating, and time on market is lengthening. Active listings at 14,335 were 11.16% higher than a year earlier. The number 5 detective online positivity is 1,500. New listings at 4,176 were lower than November, but that is seasonality. Days on market at 56, statewide, stretched the sales cycle. County by county, the pattern held with local twists. Bergen at 50 days and $762,750. Passaic at 51 days and $549,900. Morris at 50 days and $689,500. Essex at 52 days and $578,725. Sussex at 63 days and $416,975. Hudson at 57 days and $599,450. Price reductions rose in 5 of 6 counties year over year and fell in all 6 months over month. That is a market returning to discipline. In a disciplined market, small edges matter. A $950,000 bid that wins a $999,000 listing on Long Beach Island is one example. In December, with price cuts more common and days on market stretching, buyers in Essex at a median $578,725 and sellers in Bergen at $762,750 are negotiating inside tighter bands of reality. The era of throwing numbers against a wall to see what sticks is over. The era of knowing your block, your comps, and your timeline is back. Where does this go in 2026? The base case is stability, not whiplash. Expect more transactions than early 2025, supported by lower rates and steadier tariffs, and a continuing flight to quality. Multifamily and industrial should lead. Rents may be flat in the early months with concessions as vacancy tightens, then firm later as absorption continues. Conventional lenders are active again. Equity is liquid. In the third quarter of 2025, net industrial absorption turned positive for the first time in more than a year, and deliveries are limited. That combination sets up tighter fundamentals as the year unfolds. As vacancy eases, expect selective new starts aimed for 2027 and 2028 deliveries. 2 watch items will shape this base case. First, March 15. Zoning for affordable housing obligations under AFUR must be in place by that date. If municipalities meet it, approvals will accelerate, and many thousands of multifamily and mixed-use units will move from plan to pipeline. If they lag, the supply relief that could moderate prices in 2027 and beyond slips. Watch planning board agendas between January and March and the tempo of fair share plan approvals. Second, power distribution. Data center demand is strong, but reliable electrical capacity is already a premium resource. If utilities cannot deliver, projects stall. If they can, they unlock new tax bases and anchor tenants. Pay attention to interconnection queues, substation expansions, and grid capacity announcements tied to planned sites in places like Newark, Jersey City, and along major corridor nodes. There are other undercurrents worth noting as you navigate. Rising insurance premiums after frequent storms will nudge owners toward resilience spending, drainage, paving, structural reinforcement, especially in flood-prone corridors. Healthcare facilities and ambulatory centers carry fewer entitlement hurdles and may continue to outpace other non-residential uses. Office conversion opportunities will hinge on walkability and municipal flexibility. Retail resilience will persist most where tenants deliver daily needs. And for buyers and sellers, the math gets sharper when days on market hover around 50 to 63 days in North Jersey counties, and the statewide median list price sits just above $500,000. The chain is clear. December's numbers: 14,335 active listings, a $529,325 median list price, 56 days on market, describe a market shifting from scarcity to planning. The why is a blend of seasonal gravity, rate stability between 6.15 and 6.22% on 30-year loans, and a return to fundamentals. The who includes buyers winning with disciplined offers, sellers pricing closer to reality, lenders and equity returning with a focus on quality, and planners staring at a March 15 clock. What comes next depends on whether the state can translate obligations into approvals, and whether the grid can keep up with the ambition of builders. Base case: 2026 stays steady and more active than early 2025. Watch March 15 for zoning action that will shape supply through the next decade, and watch the power distribution bottleneck that will decide how fast the data economy can build. If this grounded look helped you see the path ahead, share it with someone making a New Jersey move in 2026.